As 2026 begins, investors often take this time of year to look forward and wonder what equity markets might return this year. We saw this chart from our research partners at CFRA Research recently. We thought it was a great way to take a look at bull markets, maybe their sustainability over time. So what you see here are bull markets back to the 1940s, in each row all the way down the page to our most recent one there at the bottom. And each column is your 1, 2, 3, 4, and so forth and so on of that bull market. It's important to note here that the bull market itself starts the day that the bull market started. So our current one, the specific day in October of 2022. So 1 year would be 12 months after that, October 2023. So not calendar years here, actual 12 months from the start of that. And so what you see in each column are year 1, year 2, year 3 of these bull markets, and the colors in each column tell you within a given bull market, was it one of the higher returning year ones or lower? So red would be highest, blue would be lowest, and you see the colors gradiate in the middle. So if you look all the way down to the bottom, this is our most recent bull market that we're in now that's currently in year 4, that started October of last year, year 4 that is. And so you see the first year is blue, a little bit lower return relative to other year ones of bull markets, but as you move into year 2 and year 3, you see a deeper red and a darker color, 2 of the higher returns in a year 2 or a year 3 of a bull market. And so often investors just kind of push that expectation forward. We've had 3 straight double-digit years. That's what year 4 will be. What this table shows you is that that's not actually true. So in all of the periods that we see here in all these bull markets, there is not a single straight 4-year period of double-digit returns. There's lots of reasons for that. We could probably spend a ton of time trying to figure that out. But if we think back over the last 70, 80 years that this covers, think about all the different economic environments, interest rate environments, Federal Reserve regimes from raising to lowering rates, political parties and combinations of the White House and Congress, geopolitical environments, tremendous differences throughout that period, yet that lack of a 4th year of double digits persists. So I think there's always reasons for that, and it's reasonable for us to say, that's probably what we should expect this year. So that's a lot of what this video is about, is helping us to manage expectations and realize, again, there's something that happens around that 4-year mark that doesn't necessarily cause a decline or a bear market, but a little bit of a pause or a pullback in how high those returns are. It could be valuations, it could be time in the economic cycle, whatever it may be, that trend persists. So I think that's a reasonable expectation for this year, particularly the next 9 months that would cover year 4 of this bull market. That maybe single digits or a little bit lower returns are something reasonable to expect. We would all love to be surprised and get a 4th year, and if so, we'll come back in October and tell you history has changed, and everyone will happily take that great year of equity returns in stride. Thanks for taking time today.